And Jeff, our next guest, of course, knows a thing or two about bonds and credit spread compression, and that's Michael Stewart, founder of Crystal Lake Tax and Financial, a retirement income store located just outside of Chicago. He's also Amazon best-selling co-author of the book, Purpose-Based Investing. Mike, as usual, it's our pleasure to have you back here on The Income Generation.
Happy to be here, guys.
Michael Stewart, what would you say is the number one misconception people have about investing in individual bonds?
Yeah, the biggest misconception, I think, is that individuals think they're more risky than individual bond funds. And as you like talked before, one of the concerns with that, or why that's a misconception, is that the only guarantee you really have when you're in a bond fund is whatever the price is. You don't have control over the yield. You don't have control over the maturity. There's a lot of the things that benefit individual securities, individual bonds that you actually give up going into a bond fund. So really it's an education procedure to really let people know the benefits of investing in individual bonds.
So why do you think advisors, financial advisors, recommend individual bond funds recommend bond funds instead of individual bonds themselves?
As has been shared by one of our mutual friends, Greg in Tulsa, I call it the disease of ease, right? He shares that with you. It's just so much easier for typical Wall Street firms, individual individual brokers, essentially, that just don't have the resources available to do a lot of the research, or really don't even want to take the time. If a client needs to get, pull a little bit of a risk off the table, get out of the market, go into more bond and bond-like instruments, it's just check a box. That's really that simple for the broker to do. But what you do is, once again, you give up all the benefits, or most of the benefits, of investing in individual bonds. I like to think it's laziness, but at the end of the day, I just don't think it's doing a service to the client.
So what would you say to bond investors right now who may be worried about interest rates rising again this year?
Yeah, I think there's two sides of that. So if you are an individual bond funds, I think you legitimately should be concerned. And the reason why is that whole teeter-totter of is interest rates eventually, whether it's 6 months from now or 2 years from now, begin to go up. Of course, if all you own is a bond fund, you have no assurances for return of principal or what your yield's going to be. Now, if you're invested in good credit quality individual bonds, that changes the dynamic, because once again, you know what your yield is going to be. You know what the maturity is going to be on that individual bonds. And if you extrapolate out a couple of years and you expect as interest rates will go up over the next few years, now you'll have those bonds not only paying you yield leading up to that, but assuming they're still in business, you're going to get all your principal back, the face value, when they mature, and hopefully be able to reinvest at a higher rate. So for bond fund investors, I would be concerned. For owners of individual bonds, I think it's all noise.
And Michael, do you mind sharing with our viewers and our listeners a little something about why maybe you want to sprinkle things into an income portfolio other than just bonds and preferreds to help offset this in case interest rates do spike?
Yeah, another misconception is that the only way you can get yield or even get income really is, I've got to go more safe. I've got to go specifically onto individual bonds, preferreds, things that you talk about every week, Dave, on the show. The reality is that you can get income and still get growth, through good blue chip dividend paying stocks, things that still have a growth component, but also pay a pretty sustainable regular dividend in at the same time. So you get income, but just as importantly, if you think about if inflation starts creeping up, or even as interest rates begin to rise, you want something that's going to keep up with that. So keeping up with inflation is going to be, good dividend paying stocks. So it's not always about just going into fixed income. It's about having opportunity for income and growth on the same asset.
Sure, or even other bond-like instruments like I often refer to when I talk about business development companies, BDCs, or real estate investment trusts, REITs. So Michael, once again, it's been great having you. Thank you.
Appreciate you having me.
And coming up, we'll talk about one more shocking fact that you should know. Investing in bonds doesn't necessarily mean sacrificing growth. Plus, we'll talk to our next guest, income specialist Eric Lardner from Dallas. All that and much more coming up right here on The Income Generation.